Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. Before that, let me introduce myself. My name is Diah Ramadhani with student number 23412060 from class AKT 23A Universitas Teknokrat Indonesia. In this video, I will explain a little about consolidation with acquisition at the carrying value of equity in the Advanced Financial Accounting course. Consolidation procedure. Financial statement consolidation is the process of combining two or more financial statements by two or more entities to become a complete and comprehensive financial statement that reflect all operation results, cash flow, and financial position. The acquiring company or investor will usually conduct a due diligence on the business to be acquired. Accurate result of the due diligence can indicate whether the business to be acquired has a value that is more or less than its book value. Factors that can affect the business feasible. Assessment produced during the business combination process include the business prospect of the company to be accurate, especially in creating additional income for the acquiring company, general industry condition, strategic business value, management equity, and, of course, the fair value of asset and liability reported by the company to be accurate. Next, elimination journal. The elimination journal is used to adjust the balance in each account in each entity to be consolidation so that they reflect the balance that would have been when all of the consolidation entities were considered as a single entity. Unlike general journal or adjusting journal that appear in an entity accounting cycle, this elimination journal is only used during the consolidation process and does not affect the record made by each entity separately. Consolidation in the period following the acquisition. In the period following the acquisition, several things must be considered when preparing consolidation financial statement for the acquired subsidiary, not at its carrying amount, because the acquisition that is not carried out at carrying amount creates a differential that needs to be allocated to the asset acquired or liability taken over, or even goodwill. Therefore, the parent entity needs to ensure that the differential has been measured appropriately. PSAK 22/2010 requires entities to measure and record asset acquired and liability taken over in accordance with the relevant standard for this account. For example, if the differential is allocated to fixed asset measure using the historical cost method, the company needs to ensure whether the record depreciation as operation of require additional deduction for consolidation purpose. If the differential is the caused by the emergence of goodwill, according to PSAK 22 or Receipt 2010, the entity needs to perform impairment testing for its reporting period. Next, consolidation working paper. Consolidation working paper are a tool for gathering and organizing the information needed to prepare consolidation financial statement for a parent company and its subsidiaries. A. All data present in the consolidation financial statement can be determined independently of the working papers. B. The consolidation financial statement will be the same regardless of the accounting method, or equity, incomplete equity, or cost. And C. The account that appear on the working paper do not affect the general ledger account of the parent company or its subsidiaries. Analysis with partial ownership. In preparing consolidation financial statement not at the record value of partial ownership, the thing that needs to be considered is the existence of non-controlling interest. To the extent of non-controlling interest, PSAK 63 or Receive 2040 record the parent entity to present separately the portion of non-controlling interest in equity in the consolidation statement of financial position. This is instead of show user of the financial statement how much of the net asset owned by the subsidiary are not controlled by the parent entity. In this case, the value attributed to not controlling interest include the position or profit or loss and any statement recognition as part of other comprehensive income. Other issues regarding consolidation. Transaction costs related to acquisition. Transaction costs related on the acquisition process of a company are very likely to be increased by the acquirer. Transaction costs related to acquisition can include brokerage fees, legal and consulting fees, accounting-related costs, valuation fees, and other professional service, general administrative costs, and registration or issuance costs if the acquirer used debt to equity instrument. According to PSAK 22, all transaction costs related to acquisition must be charged to the period when the costs are incurred by the service are received except for the cost of using securities in the form of debt or equity, the treatment of which follow PSAK 55 with our Receive 2040. Okay, that's a little bit of material from me, hopefully useful. If you have any question, please write them in the comment column. I apologize if there are any wrong words. Thank you. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.